Welcome to Invyra, your AI-powered investment intelligence platform. Invyra helps you find stocks trading below their true value, using advanced financial analysis and real-time market data. This is the Invyra app. At the top, you'll find 6 powerful tools. Financial analysis breaks down a company's numbers. Mode analysis evaluates competitive advantages. The AI investment thesis gives you an automated investment recommendation. Supply chain maps show how companies are connected. Smart money intelligence tracks what big institutional investors are doing. And the Invyra IV engine calculates the true intrinsic value of any stock. Below, you can see live market news and the S&P 100 valuation screener. The S&P 100 valuation screener ranks every stock from most undervalued to most overvalued. So what is intrinsic value? It's what a stock is actually worth, based on the company's future cash flows, discounted back to today. If the market price is below that number, the stock is undervalued, and that could be a buying opportunity. Each card shows the ticker, company name, calculated intrinsic value, the discount percentage, and a quality rating. Green badges mean undervalued. For example, Comcast shows 65% below its intrinsic value with a strong quality rating. Switch to the Fair Value tab, and you see stocks trading near their calculated worth. These aren't bad investments. They're just priced close to what the math says they should be. Amber badges indicate fair value territory. The Overvalued tab shows stocks trading above their intrinsic value. Red badges warn you that the market may be pricing in too much optimism. Broadcom, for example, shows 153% above its intrinsic value, meaning the stock price is more than double what the fundamentals suggest. Now, let's look at market intelligence. Market mood is Invyra's proprietary sentiment indicator. Think of it as a thermometer for the stock market's emotions. It combines 5 signals into one score from 0 to 100. Momentum at 58 measures how strongly prices are trending, slightly positive. RSI at 43 tells us the market isn't overbought or oversold. Volatility at 63 shows moderate turbulence. Breadth at just 2 means very few stocks are participating in the rally. That's a warning sign. And valuation sits at 54. The combined reading is 47, neutral, meaning the market isn't overly excited or overly fearful right now. Next is the Fear and Greed Index, powered by CNN. This measures whether investors are acting out of fear or greed on a scale from 0 to 100. A score of 26 means we're deep in fear territory. You can compare across time frames. Previous close was 28, 1 week ago was 37, 1 month was 54, and 1 year ago it was just 15. Here's a key investing insight. When fear is high, experienced investors often find the best buying opportunities because stock prices tend to be beaten down below their true worth. The S&P 500 trend panel shows the market's direction across 3 time frames. Short-term shows a downtrend. That's recent weakness you can see in daily price action. But both medium-term and long-term trends remain uptrend. The overall reading is cautiously bullish. The big picture is positive, but there's some near-term caution warranted. Now let's dive into macro pulse. These are the big economic forces that affect every stock valuation. There are 4 indicators here, and each one tells you something crucial about the investing environment. First, the 10-year Treasury yield, currently around 4.03% and rising. This is the interest rate the U.S. government pays to borrow money for 10 years. Why does this matter for stocks? Because this rate is used as the baseline for valuing all investments. When it goes up, future company earnings are worth less in today's dollars, which pushes stock valuations down. Invyra uses this rate directly in its intrinsic value calculations. That's why you see it labeled as a headwind for equities. Rising rates mean lower valuations. Next, the yield curve, currently stable with low risk. The yield curve compares short-term and long-term interest rates. Normally, long-term rates are higher. That's a healthy economy. But when the curve inverts, meaning short-term rates exceed long-term rates, it has historically been one of the most reliable recession warning signals. Right now, the curve is stable, which means no immediate recession risk on the horizon. Credit stress is reading calm. HYG, the high-yield bond fund, is trading near its 52-week high, just 1.6% below. This measures how nervous the bond market is. When companies with lower credit ratings can still borrow easily, it means investors have a healthy appetite for risk, and that's good for stocks. If this indicator ever flashes stressed, it would signal credit markets are tightening, often a precursor to stock market trouble. Finally, the inflation signal, currently stable. This tracks inflation expectations by watching TIPS, Treasury inflation protected securities. Stable inflation is good for stocks because it means the Federal Reserve is less likely to raise interest rates aggressively. If inflation were rising, the Fed would tighten policy, which typically hurts stock prices. Right now, inflation is neutral for equity positioning. Want to analyze a specific company? Just type a ticker in the search bar. Here we've searched for AXB, American Express. Invyra instantly shows a detailed analysis page. Look at the value creation panel. American Express has a return on invested capital of 30% versus a cost of capital of just 6.3%. That huge spread means the company is creating significant value for shareholders. The poll score of 19 shows panic territory, suggesting the stock may be oversold and could present an opportunity. You also get a full AI-generated company overview, stock charts, financials, mode analysis, and much more. That's Invyra. See the intrinsic value behind every stock. Visit Invyra.thincrium.ai to get started today.